This presentation is devoted to the fair value valuation of insurance contracts, with a focus on life insurance liabilities. The question is not only accounting-based, it is also actuarial and financial. How should we value promises made today when the corresponding cash flows may occur many years later? These cash flows depend on future discount rates, on future mortality levels, and on the actual death experience of the portfolio. The chapter is written in the historical context of IFRS 4, but the mathematical issues remain central for current valuation. We will therefore use this chapter to connect insurance accounting, stochastic interest rate modeling, stochastic mortality modeling, and incomplete market risk management. We begin with an overview of the chapter. The objective is to identify the valuation problem before introducing the technical machinery. The chapter first explains why fair value represented a major change for insurers. It then separates the sources of risk in life insurance liabilities, introduces the information structure used for valuation, and compares actuarial and market-based approaches. The second part reviews interest rate and mortality models, and the final part applies the framework to a portfolio of life insurance contracts. The chapter starts from the fair value debate surrounding IFRS 4. Insurers were asked to move from local accounting practices towards a current valuation of liabilities that could be more transparent and more comparable across companies. The actuarial difficulty is that life insurance cash flows are long-term and uncertain in several dimensions. Interest rates determine how future payments are discounted. Mortality trends determine whether death benefits, survival benefits, and annuity payments are likely to occur earlier or later than expected. Even if the mortality law were known, the actual dates of death in a finite portfolio would still remain random. Financial risk can be treated with the standard no arbitrage framework of mathematical finance, where discounted prices are martingales under a risk-neutral probability. Mortality risk requires more care because it contains a systematic component linked to changes in mortality levels for a whole population and a diversifiable component linked to the random experience of individual insureds. The chapter compares two valuation philosophies. The actuarial approach uses risk-neutral valuation for financial risk and best estimate real-world mortality. The market approach uses a hybrid risk-neutral probability for both interest rate and mortality risks. The relevance of this second approach depends on whether mortality-linked markets are sufficiently deep and liquid. The first part places the problem in its historical accounting context. The point is not to present a complete accounting standard, but to understand why the valuation of insurance liabilities became a methodological issue. Traditional accounting focused on prudence and on the emergence of profit through time. Fair value thinking placed the contract itself at the center of measurement and asked how the remaining obligations should be valued at the reporting date. IFRS 4 should be understood as an interim standard that opened a broader debate on current measurement. The International Accounting Standards Board aimed to improve the transparency and comparability of financial reporting. For quoted financial assets, fair value is relatively direct because the market provides observable prices. For insurance liabilities, the situation is different. There is no active secondary market where life insurance obligations are continuously bought and sold between professional counterparties. Portfolio transfers exist, but they are regulated transactions and do not provide a continuous price system. In the IFRS 4 debate, fair value was interpreted as the amount for which an asset could be exchanged or a liability settled between informed and willing parties in an arm's length transaction. Applied to insurance, this definition immediately raises modeling questions. The insurer must value future premiums, future benefits, possible lapses, interest rate scenarios, and mortality assumptions. The chapter keeps this historical terminology because the same mathematical issue remains relevant. Even under later frameworks, long-term insurance cash flows require coherent assumptions on financial markets and biometric uncertainty. Fair value, therefore, marks a transition from book value reasoning to current economic measurement. Insurance liabilities are difficult to value because insurance production is inverted. Premiums are collected, before the final cost of benefits or claims is known. In life insurance, the insurer makes long-term promises and only gradually observes the actual experience of the portfolio. A contract is also naturally valued inside a portfolio. Two insurers may assign different economic values to the same risk because their underwriting, segmentation, reinsurance, and asset liability management differ. This portfolio dependence explains why insurers were skeptical about a pure exchange value interpretation. Comparability is another challenge. Liability values may depend on lapse assumptions, expenses, mortality improvement, discount curves, and policyholder behavior. Without transparent assumptions, two reported values may not be comparable, even if both are called fair values. Finally, current valuation can increase volatility. A change in long-term interest rates can strongly affect the present value of guarantees or annuities. A revision of mortality assumptions can also remeasure future benefits. Fair value valuation improves economic visibility, but it also makes the balance sheet more sensitive to market movements and model choices. We now move from the accounting motivation to the valuation framework. The first task is to identify the risks embedded in a life insurance contract. The second is to describe the information available to the market, to the mortality modeler, and to the insurer observing its own portfolio. This distinction matters because valuation is always conditional on a filtration, that is, on the information known at the valuation date. A life insurance contract is first exposed to financial risk. In this chapter, the main financial risk is interest rate risk. It is particularly important for long-duration annuities, endowments and savings contracts because small changes in long-term rates can produce large changes in present values. Some of this exposure can be hedged with financial instruments, but perfect hedging may be unavailable for very long maturities. The second source is non-diversifiable mortality risk. This is the risk that future mortality levels evolve differently from expected. If longevity improves faster than anticipated, annuity liabilities become more expensive. This risk affects many contracts in the same direction and cannot be eliminated simply by increasing portfolio size. It may be partly offset by combining products with opposite mortality exposure, such as annuities and death insurance. The third source is diversifiable mortality risk. Even under a known mortality law, the actual deaths in a finite portfolio occur randomly. Pooling many homogeneous insureds reduces this component through the law of large numbers. The chapter assumes independence between financial and mortality drivers. This is a simplification, but it is reasonable because mortality trends usually evolve much more slowly than financial markets. The displayed expression defines the global information available at time t. It combines three types of information. The first component represents the financial information revealed by markets, such as bond prices, interest rates, and other traded financial quantities. The second component represents information about the evolution of mortality levels. This is the information used to update assumptions on future forces of mortality. The third component represents the information generated by the insurer's own portfolio, in particular the number of survivors or deaths observed up to time t. These three information sets are aggregated into a single filtration. This may look technical, but it is essential for valuation. Financial cash flows are conditioned only on market information, whereas insurance cash flows must be conditioned on market information, mortality information, and the actual portfolio state. The counting process for deaths has jumps, and the insurer observes it only as events occur. This is why the chapter carefully distinguishes information immediately before and after death events. The framework makes it possible to formulate reserves, surplus processes, and changes of probability measure rigorously. The formulas on the slide recall the standard no arbitrage valuation of financial cash flows. The money market account accumulates at the short rate, so it is the natural numeraire for discounting. Under the absence of arbitrage, there exists an equivalent risk-neutral probability under which discounted asset prices are martingales. This means that the current price of a financial asset is the conditional expected discounted value of its future payoff under that probability. A zero-coupon bond is the simplest example. It pays one monetary unit at a future date, and its price is the expected stochastic discount factor under the risk-neutral measure. The important actuarial message is that this framework values financial uncertainty through market consistency, not through real-world expected returns. If a future cash flow can be replicated by a self-financing trading strategy, its value must be the cost of that replicating portfolio. If markets are incomplete, valuation may lead to a range of admissible prices, and additional criteria are required. This prepares the discussion of insurance liabilities, where mortality risk is not generally spanned by traded financial assets. The actuarial approach uses a product probability measure. Financial risk is valued under the risk-neutral probability of the financial market, while mortality risk and portfolio death risk are valued under the real-world probability used by the insurer. This approach preserves the independence assumption between financial and mortality drivers. It is natural when mortality-linked securities are rare, illiquid, or insufficiently reliable to infer a market price of mortality risk. The insurer then uses best estimate biometric assumptions and market-consistent discounting. The financial approach takes a different view. It assumes a hybrid market in which interest rate risk and mortality risk are both valued under an equivalent risk-neutral measure. This is conceptually attractive if mortality risk can be traded, for example through longevity bonds or other mortality-linked securities. However, the hybrid market remains incomplete. Forces of mortality are stochastic, and the exact timing of death benefits and annuity payments is random. In finite heterogeneous portfolios, these cash flows cannot generally be replicated by traded assets. The difference between the two paradigms is therefore not the list of cash flows, but the probability measure used to value mortality uncertainty. We now turn to interest rate modeling. Life insurers need a term structure model because their assets and liabilities often extend over several decades. The model must be compatible with the initial yield curve, must avoid arbitrage, and must generate plausible future scenarios for short and long maturities. The chapter reviews several families of models, each with different strengths and limitations. The equations on the slide give equivalent descriptions of the interest rate term structure. The zero coupon price is the price today of 1 unit paid at a future maturity. From this price, one obtains the spot rate for the corresponding maturity. The short rate is the instantaneous limit of the spot rate when the maturity approaches the current date. The same zero coupon price can also be reconstructed from instantaneous forward rates by integrating the forward curve over time. These objects are different representations of the same economic information. A useful term structure model must satisfy several requirements. It must be arbitrage-free, because otherwise it would contradict observed market prices. It must be tractable enough for pricing and hedging derivatives. It should be continuous time to remain consistent with the valuation formulas of the chapter. It should also reproduce important empirical features of interest rates, including curve shapes, persistence, and the behavior of long rates. Mean reversion is usually desirable for interest rates because very high or very low rates tend to trigger economic and monetary responses that bring them back towards more normal levels. Affine short rate models, including Vasicek and Cox-Ingersoll-Ross, model the whole yield curve as a function of the short rate. Their attraction is analytical tractability. Bond prices and some transforms can often be written in explicit or semi-explicit form, which is useful for valuation. Their weakness is limited flexibility. In a one-factor version, all zero coupon rate movements are driven by the same underlying factor, so correlations across maturities are too strong, and the model cannot reproduce all observed curve movements. Heath, Jarrow, Morton models take another route. They model zero coupon bond prices or instantaneous forward rates directly. This makes the model consistent with the initial market yield curve by construction, which is an important advantage for current valuation. The difficulty is that the volatility structure must be specified carefully, and numerical implementation can become demanding. Cairns-type positive rate models belong to a class where zero coupon prices are represented through positive martingales. Their goal is to generate realistic long-term scenarios while preserving positive rates. They can reproduce richer long-rate behavior, but their parameters are harder to estimate. The chapter therefore emphasizes the usual trade-off between tractability, empirical realism, and calibration. The second modeling block concerns mortality. The analogy with interest rates is useful because survival probabilities can be described through a term structure of mortality rates. but the modeling problem is different. Mortality probabilities are not continuously quoted on a liquid market, and mortality trends should reflect long-term demographic improvements rather than financial mean reversion. The displayed formulas define the mortality term structure for an individual aged X at the initial date. The survival probability is an ex-ante conditional probability. It is the probability, given current mortality information, and survival up to the valuation date, that the individual will still be alive at a future date. It should not be confused with the survival proportion that will later be observed in the portfolio. The force of mortality is the instantaneous mortality intensity. It plays for survival probabilities the same local role that the short rate plays for discount factors. When this intensity is integrated over a future interval, it determines the survival probability over that interval. The chapter also defines forward mortality rates, which describe mortality expected for future ages and future calendar dates. This is important because a life insurer does not only need today's mortality by age, it needs a projection of future mortality for insureds who will age over the lifetime of the contract. The analogy with interest rates is helpful, but mortality has an additional age dimension, so the model must capture both calendar time effects and attained age effects. A mortality model must first be consistent with historical observations. For many populations, forces of mortality have declined over long periods, but not uniformly across ages. The model must allow the pace of improvement to differ between young ages, adult ages, and old ages. It must also preserve positivity, because mortality intensities cannot be negative, and it must allow large values at advanced ages so that survival probabilities remain realistic. Unlike interest rates, mortality trends should not be forced to mean revert. If mortality improvements have been stronger than expected, it is not natural to assume automatically that future improvement potential is exhausted. Historical data often show persistence in mortality improvement with long periods of rapid or moderate decline. The model must therefore be usable over very long horizons because annuity and pension liabilities may extend for decades. Finally, the model must be estimable. A very sophisticated model is not useful for actuarial valuation if its parameters cannot be estimated reliably from demographic data. The chapter therefore favors models that balance demographic realism, tractability, and valuation feasibility. Deterministic reduction factor models start from a baseline mortality curve and apply an age-dependent reduction factor to represent future improvement. They are simple and transparent, and they connect naturally with life tables, but they ignore uncertainty in future mortality trends. Affine exponential models extend the Lee-Carter logic by modeling the logarithm of the force of mortality through stochastic period factors. In the continuous time versions discussed in the chapter, these factors may be Brownian motions with drift. This captures uncertainty and the persistent downward trend in mortality, but closed-form death probabilities are not always available. Multi-factor affine models represent the force of mortality as a deterministic age-time component plus stochastic affine factors. Their main advantage is analytical structure. Survival probabilities can often be expressed in exponential affine form through systems of differential equations. The chapter also discusses Maycomb-type specifications, where mortality is decomposed into an age-independent component and an exponentially increasing aging component. These models are useful for valuation formulas, but they have limitations. Mean reverting factors may fail to capture long-term mortality improvement, and Gaussian factors can imply a non-zero probability of negative mortality intensities. The final technical part applies the preceding tools to a portfolio. The chapter considers insureds of the same initial age and a contract combining survival contingent and death contingent payments. The aim is to show how reserves are computed under the actuarial and market approaches and how the resulting surplus can be analyzed when only financial assets are available for hedging. The portfolio consists of n insured individuals, all aged X at the initial date. Their remaining lifetimes are random variables. Conditional on the future mortality environment, these lifetimes are independent and identically distributed, with survival driven by the stochastic force of mortality. This separates systematic mortality uncertainty from individual death randomness. The death counting process records the number of deaths observed up to time t. Its intensity is the number of individuals still alive just before T multiplied by the current force of mortality. This gives a precise representation of diversifiable mortality risk. The contract used in the chapter combines standard life insurance components. A deferred capital is paid at a future date if the policyholder is alive. A deferred annuity is then paid continuously over a later interval as long as the policyholder survives. A death benefit is paid if death occurs before the terminal date. On the premium side, the insured pays an initial premium and then continuous premiums while alive, up to the deferral date. This example is rich enough to illustrate discounting, survival contingent payments, death contingent payments, premium obligations, and portfolio aggregation. The reserve formula on the slide gives the conditional value at time t of future benefits minus future premiums for the whole portfolio. Cash flows are discounted with the future short rate path, and the expectation is taken under the actuarial product measure. Because this measure uses risk-neutral valuation for interest rates and real-world valuation for mortality, the expression separates into financial discount factors and survival probabilities. The second relation states that the portfolio reserve is the number of survivors at time t multiplied by the reserve of one surviving policyholder. This is a useful simplification. At the individual level, the insurer's liability has three components. The deferred capital is valued by multiplying a zero coupon price by the probability of survival to the deferral date. The deferred annuity is valued by integrating future payments weighted by discount factors and survival probabilities. The death benefit is valued by integrating over possible death times, with each date weighted by survival up to that date and by the forward mortality intensity. The premium obligation is valued similarly to a survival contingent annuity paid by the policyholder. This decomposition shows the actuarial logic of fair value under best estimate mortality assumptions. The market approach keeps the same cash flow structure but changes the probability measure. The reserve is now evaluated under a hybrid risk-neutral probability defined on the full insurance and financial information. As a result, the survival probabilities used in the valuation are market implied rather than purely real world. The chapter describes the change of measure through a likelihood process. This process may contain a premium for financial Brownian risk, a premium for systematic mortality risk, and an adjustment for the jump risk associated with individual deaths. If the market assigns no price to diversifiable mortality risk, the jump adjustment is zero. This corresponds to the idea that individual death randomness can be pooled in a large portfolio and should not require a market premium. If, in addition, there is no premium for systematic mortality risk, the hybrid valuation coincides with the actuarial product measure valuation. The economic distinction is therefore clear. The actuarial approach treats mortality with best estimate assumptions. The market approach replaces them by market-implied survival probabilities whenever mortality risk is priced by traded instruments or by an accepted market-consistent mechanism. The last section moves from valuation to hedging. Once a liability value has been computed, the insurer must understand which part of the surplus can be hedged with financial assets and which part remains unhedgeable. Interest rate risk can be partly hedged with bonds, but random deaths and stochastic mortality trends generate a residual component that cannot be spanned by purely financial instruments. The first relation defines the discounted surplus process as the observed discounted net cash flow minus the discounted reserve for the remaining obligations. Under the actuarial valuation measure, this process is a martingale. However, it has jumps because deaths occur at random dates. If the surplus were continuous and driven only by tradable financial risk, it might be replicated by a self-financing strategy using zero-coupon bonds and the money market account. Mortality prevents perfect replication. The insurer can trade bonds, but it cannot trade the exact death times of the policyholders in its own portfolio. The chapter therefore uses risk-minimizing replication. The second relation is the Galchuk-Kunita-Watanabe decomposition. The integral with respect to the discounted zero-coupon price represents the hedgeable financial component. The remaining martingale is orthogonal to the financial asset process and represents unhedgeable risk. This residual risk comes from death occurrences and from changes in mortality intensity that are not spanned by the financial market. The resulting strategy is not perfectly self-financing, but it remains as close as possible to a self-financing strategy in a mean-square sense. The conclusion returns to the main message of the chapter. Fair value valuation is not simply a matter of choosing a discount curve. It requires a coherent framework for financial risk, systematic mortality risk, and diversifiable portfolio risk. It also requires transparency about which risks are market priced and which risks are assessed through actuarial best estimate assumptions. Fair value valuation connects insurance accounting to an economic view of liabilities at the valuation date. A life insurance liability is not only an accumulated technical reserve based on historical assumptions, it is the current value of future premiums and benefits under a specified valuation framework. Interest rate risk is the component that fits most naturally into no arbitrage valuation. Zero coupon prices and risk-neutral discounting provide a market-consistent way to value purely financial cash flows. Mortality risk is more delicate. Systematic mortality trends must be modeled explicitly because they affect whole portfolios, especially annuities and pension liabilities. Diversifiable mortality risk can be reduced by pooling, but it still creates jumps in finite portfolio surplus. When no deep and liquid mortality market exists, actuarial valuation under best estimate assumptions remains a natural benchmark. When mortality risk is traded or priced, a market approach can be used, but it requires a clear mortality risk premium. The final message is that a fair value number is meaningful only with its assumptions and sensitivity analysis. The insurer must identify the roles of yield curve movements, mortality improvement, portfolio experience, and residual unhedgeable risk.